we need to talk about something that can really make a difference in your financial life: how to build and maintain an excellent credit score. Whether you're just starting out or looking to boost your current score, this video is packed with tips and insights to help you out. I'm going to keep it simple and straightforward, with real-life examples and practical steps you can take right now. So, let's start with the basics. What exactly is a credit score? In simple terms, it's a number that shows how trustworthy you are when it comes to borrowing money and paying it back. Credit scores range from 300 to 850. If your score is above 700, that's considered good. If it's over 800, you're in excellent territory. Now, you might be wondering why your credit score matters so much. Well, having a good credit score can save you a ton of money over your lifetime. It affects your ability to get loans, credit cards, mortgages, and even impacts the interest rates you'll pay. Let's say you have a credit score of 760. You might qualify for a mortgage interest rate that's 1.5% lower than someone with a score of 620. On a $200,000 mortgage, that difference could save you over $60,000 in interest over 30 years. That's a huge chunk of change. All right, now let's break down how your credit score is calculated. There are 5 main factors: payment history, credit utilization, length of credit history, credit mix, and new credit. Payment history is the biggest factor, making up 35% of your score. Lenders want to see if you've paid past credit accounts on time. Even one missed payment can drop your score significantly. Imagine missing a $30 credit card payment by accident and seeing your score drop by 100 points. That's how important it is. Next, we have credit utilization. This is the amount of credit you're using compared to your total credit limit. It's best to keep your credit utilization below 30%. So, if you have a credit card with a $1,000 limit, try not to carry a balance of more than $300. Lower is even better. If you can keep it under 10%, that's ideal. The length of your credit history accounts for 15% of your score. The longer your credit history, the better. This includes the age of your oldest account, the age of your newest account, and the average age of all your accounts. For example, if you've had a credit card for 10 years and a car loan for 2 years, your average length of credit history is 6 years. The older your credit accounts, the more they show your ability to manage credit over time. Credit mix is another factor. Lenders like to see that you can manage different types of credit, such as credit cards, car loans, and mortgages. Having a mix of credit types can improve your score, but don't go opening new accounts just for the sake of diversity. Only take on debt you need and can manage responsibly. Finally, new credit makes up the last 10% of your score. Every time you apply for credit, it results in a hard inquiry on your report. Too many hard inquiries can lower your score. For example, if you apply for multiple credit cards in a short period, it signals to lenders that you might be a higher risk. It's like when you're shopping for a car loan. If you do all your loan rate shopping within a short window, say 14 to 45 days, it's usually treated as a single inquiry for scoring purposes. Now that you know how your credit score is calculated, let's talk about building an excellent credit score from scratch. If you have no credit history, getting a secured credit card is a great way to start. You'll need to make a cash deposit, which becomes your credit limit. Use this card for small purchases and pay the balance in full every month. For example, if you deposit $300, your credit limit is $300. Use it for a few small expenses each month and pay it off completely to show good payment habits. Another strategy is to become an authorized user on someone else's credit card. Ask a family member or close friend with good credit if you can become an authorized user on their credit card. Their good payment history will be added to your credit report, which can help boost your score. Just make sure the card issuer reports authorized users to the credit bureaus. You can also apply for a credit builder loan. Some banks and credit unions offer these loans specifically designed to help people build credit. You'll borrow a small amount and make fixed payments over a set period. The bank holds the loan amount in a savings account, and you get the money back after paying off the loan. Once you have some credit established, maintaining and improving your score is the next step. Paying your bills on time is a non-negotiable. Set up automatic payments or reminders to make sure you never miss a due date. Remember, payment history is the biggest factor in your credit score, so you absolutely need to make your payments on time. It's also important not to close old accounts. The length of your credit history matters, so keep your oldest accounts open even if you're not using them regularly. For example, if you have an old credit card with no annual fee, keep it open and use it here and there to keep it active. Limiting new credit applications is another key step. Only apply for new credit when you really need it. Each application results in a hard inquiry, which can lower your score. For example, if you're planning to buy a car, shop around for the best loan rates within a short period. You also need to be regularly monitoring your credit report. Check your credit reports for errors or fraudulent activity. You're entitled to a free credit report from each of the 3 major credit bureaus: Experian, Equifax, and TransUnion, once a year at annualcreditreport.com. Dispute any errors you find to make sure that your score reflects accurate information. A glitch in the system could bring your score down by hundreds of points, so you need to be on the lookout for errors. They can have huge consequences for your credit score. Let's look at some real-world examples to illustrate these points. Let's say you're trying to buy a car and need an auto loan. If you have a credit score of 760, you might qualify for a 3% interest rate. However, if your score is 620, you might only qualify for a 6% interest rate. On on a $20,000 loan over 5 years, the difference in interest can be over $1,500. That's a significant amount of money you could save just by having a better credit score. Now think about renting an apartment. Many landlords check your credit score to decide if you're a reliable tenant. A higher score can make you a more attractive candidate and even give you more negotiating power when it comes to your security deposit or lease terms. For example, a landlord might ask for a smaller deposit or offer better lease terms if they see you have a solid credit history. And what about when you're shopping for insurance? Did you know that some insurers use credit scores to set premiums? If you have a higher credit score, you might get lower rates on car and home insurance. It's another way a good credit score can save you money. Building and maintaining an excellent credit score takes time and discipline, but it's worth the effort. If you found this information helpful, please give this video a thumbs up and subscribe for more tips on managing your finances. If you have any questions or topics you'd like me to cover, drop them in the comments below. I'll see you next time.